When you accumulate a few years in investment research, you begin to realize that many times it's not the level of a given data point within a data series, but often the direction of that data series that can impact capital markets. In this latest edition of LPL Street View, we are going to put a spotlight on this concept of directional change and talk about why capital markets have been shaken up a bit as we start 2022. In recent months, market participants have been faced with a directional change in the expectations of Fed policy. Investors now believe there will be more Fed rate hikes in 2022 than previously expected. Market participants have been faced with a directional change in potential economic growth. Forecasters now expect U.S. GDP growth to decelerate rather than accelerate. Market participants have been faced with a directional change in fiscal policy. We are not expecting fiscal policy to provide the degree of tailwind in 2022 relative to 2021 as COVID and post-COVID stimulus fades. And as this chart shows, market participants have also been faced with a directional change in consumer confidence as inflation pressures have been felt from the grocery store to the gas station, and economic confidence feels just a little bit less steady. What is our point here? Well, the directional change in the elements we mentioned and in multiple other data series that we follow have resulted in a change in premium on which investors are willing to pay for risky assets. This has in part led to the recent shift in asset prices. Said another way, the investment landscape has become more uncertain as we transition from a fast growth exit from 2020 COVID restrictions to developing signs of a more normalized, slower growth environment. This transition has caused a recalibration of risk-taking across capital markets. This doesn't mean you should not have a formidable allocation of risk-based assets in your portfolio, depending, of course, on your personal risk tolerance. What it does mean is that the directional change in many data series should cause you to reduce your return expectations and ensure you are positioned for more price volatility ahead. Notably, at LPL Research, we still favor equities over bonds in 2022, but our conviction levels are reduced relative to last year. We're also paying close attention to the recent decelerating pattern in market data, and we are busy deciphering what it could mean for our tactical positioning ahead. Thanks for listening, and certainly in 2022, you should be allocating wisely.